right, welcome to lesson 17, the income statement. So, like the balance sheet that we explored in Unit 2, an income statement is another financial statement that summarizes the items of revenue and expenses and shows the net income or net loss of a business for a given period of time. So, unlike the balance sheet that just shows the capital, we are looking at, you know, the owner's equity section completely in the income statement. Okay, so some features that are included in the income statement are as follows. Number one, the heading. So, like the balance sheet, like the trial balance, we have a 3-line heading. So, in the first line, we have the name of the business, like the other statements. In row 2, we have the name of the statement, which is the income statement in this case. And in the third line, we have the accounting period. So with the balance sheet, we just had the specific date, right? Because the balance sheet shows a snapshot on a certain day. In this case, with the income statement, we are looking at a period of time. So this might mean year ended. This might mean month ended. So it's not just one date. You have to specify what period it is recording. With the income statement, the first piece of information that we have is the revenue section. Okay, this revenue section shows an increase in owner's equity. This is an increase because it results from the proceeds of the sale of a good or a service. So they may result from selling products, doing services, renting property, or even lending money if you are gaining interest. They usually result in an increase in an asset like cash or accounts receivable, which we've looked at as we've gone through the different transactions. And when we've seen, an increase in cash, sometimes we're increasing our owner's equity. Well, this is the specific account in owner's equity that is affected. Some businesses have more than one revenue account. You might see it being called sales, fees earned, interest earned, commissions earned, etc. So that earned word is very important there. It's money that we earn as a business. Okay. The second part of the income statement is the expense section. Okay. Now, the expense section shows a decrease in equity resulting from the cost of goods or services used to produce the revenue. So it's the money that we're spending to produce the good or the service. Examples include a utility expense, a phone expense, a rent expense, internet expense, wages expense, interest expense, etc. And so again, this is showing a decrease in that owner's equity section. With expenses, we have two different types. Number one being fixed expenses, and these are expenses that are typically the same every single month. So it doesn't matter how much you are selling, how much you are producing, how much, how many services you're providing, the expenses are going to be the same month to month. So for example, rent expense, rent is going to be the same every single month. Insurance expense, your cell phone expense, if you have an Amazon membership expense. So these are, again, amounts that are the same month to month. This should not change drastically. Sometimes things go up in price, rent typically increases each year, but it's not by a large amount. And again, it's not changing every single month. The second type of expense is what we call a variable expense. These expenses will be more difficult to estimate and will be based on your assumptions for revenue. They can possibly change every single month. So for example, gas expenses, depending on how much you drive, is going to be dependent on how much gas you need. An electricity expense, same thing. Depending on how much you use, that's how much you are going to have to pay. An emergency expense. You can expect that as revenue increases, so will your variable expenses or vice versa. So it's the cost of doing business. The more revenue you have, typically the more expenses you have as well, because it takes money to make money. So together, when we look at the revenue section and the expense section, we're able to see, okay, is our business at an income or a loss, a net income or a net loss? This is not cash. This is the difference between the total revenues and the total expenses listed on the income statement. So if revenues are greater than expenses, which we want them to be, you have a net income. That will be the result. You want the revenues to be greater than the expenses. You want more money coming into the business than what's going out of the business. However, sometimes that's not the case. And in that case, if revenues are less than the expenses or expenses are greater than revenues, a net loss is a result. The income statement is used by different shareholders, one being owners and managers, just to see how much profit a business is making. It's important because a business will not survive if they are, in a net loss for a long period of time. Bankers need to know if the borrower will be able to repay the loan. So if a bank sees that, you have a net loss, you're going to be a riskier loan to provide. Income tax authorities, the income statement must be sent to the government along with the owner's income tax return. So that is another shareholder that would be interested in, seeing what the income statement is all about. The income statement is important because it looks at debt repayment. So how much do you need to pay every single month on any debt that the business has? So for example, a loan. These should be easy to estimate because they are likely based on a contract. They will not change much from month to month unless you take on added debt. So once you have that contract in place, it should, look the same every single month. Now, with the fiscal period, this is the period of time over which earnings are measured. Net income is measured over a specific length of time. Typically, this is 12 months. So when we talk about a fiscal period, most businesses use, a 12-month period. However, that doesn't mean that it follows our calendar year. So from January 1st to December 31st. Your fiscal year could start in October. It could start in June or July. But it is typically 12 months in length. Okay, another aspect that is a part of this lesson is what we call the chart of accounts. So when we think back to the ledger and all of our accounts that are listed in that ledger, we know that each account has a title. Okay, now what we also are going to add onto our accounts is our number. Now, accounts are placed in a ledger in numerical sense so that they may be located quickly. So as we know from the ledger, we list our assets first, then our liabilities, then our owner's equity. And so our numbers are going to follow that pattern. So typically, asset accounts could be from 100 to 199. So cash could be 100. An accounts receivable account could be 109, as long as they're labeled and they are all in that bracket, in that range. Liability accounts can be from the 200 to 299. Owner's equity accounts could be from 300 to 399. Revenue accounts 400 to 499. Expense accounts 500 to 599. Now, again, we want to make sure that we're following this order, but our numbers can, vary depending on the business. Okay, so let's look at an income statement example. This is for EBOA for the month ending January 31st, 19, and we don't know the actual specific year. However, as you can see, my first difference that I see between an income statement and a balance sheet is that it's not just the date. It is to show the period. So 4-month ending January 31st, not just January 31st. Okay. Then we have our revenue and we have it bolded. If you were writing it by hand, you could underline it. And we have only one account in this case for revenue. So our total revenue is in the second column here, and we have a dollar sign. Okay, just like with the balance sheet, our first number is going to have that dollar sign. And in this case, our revenue is $23,660. Okay, then we have our expenses. Again, we have our heading here. If you're gonna bold or underline, it's up to you depending on if you're using a computer or doing it by hand. And then you have your expenses listed. As you can see, they are listed in alphabetical order here. So our first expense account will also have a dollar sign, just like with the balance sheet. Our first number is going to have that dollar sign. And because we have more than one expense account, we have to add them together. So again, this single underline under the wages expense is going to show that we're adding these expenses together. Then we have total expense, and our total expenses is also going to go in the second column here under the revenue. Okay. And once we have that total, we can take our total revenue and subtract our total expenses to find if we have a net income or a net loss. In this case, because our revenue is greater than our expenses, which is a positive thing, we have a net income. And as you can see, our net income is going to have a dollar sign and a double underline, just like with the balance sheet. Here's another example. So in this case, we have more than one revenue account. Okay, so we are going to list our revenue accounts in the first column. Again, we're starting with a dollar sign for the first value, and my total revenues is going to go in the second column with with a dollar sign because it is the first number in this column. Then we are looking at our expenses, and again, we have them listed in alphabetical order. We are going to put a dollar sign to show that's the first expense, add them together. We're going to have the single underline to show that we're adding them. And then our total expenses will go into the second column. And we will take our revenue, our total revenues, and subtract our total expenses. Again, this single underline is showing that we're doing a subtraction here. And our revenue is greater than our expenses, so we can see that we have a net income. I wrote in your notes here that this does have a double underline. It's just difficult to see in this example. Here in the notes, I listed the steps in preparing an income statement for you to follow through with, and making sure that just like with the balance sheet and even the trial balance, that our format is perfect. With financial statements, we need to make sure that everything is listed accordingly and all of our numbers are in the correct spot and our calculations are also correct. Now, in this lesson, you are going to complete a task that will be assessed. So please have a look at the other example, the practice example that I gave you, and then look at the answer before, trying the task on your own. And let me know if you have any questions or concerns about this task. Good luck.